Good morning. This is the Retired Employees Healthcare Benefits Trust, Wednesday, July 27th, 7:30 a.m. at Town Hall. First item is attendance, and we have all members here, myself, Jason Tice, Treasurer Brian Keeps, and Trustee Michael Shostak, along with our presenter, Brian from ANCO Consulting. The next item is public comment. Is there any public comment?
My name is Mark Antockley. I reside at 1550 Georgetown in Bloomfield Township. My public comment is regards to the split between the town funds and the public safety funds, and what appears to be a manufactured public safety financial crisis. In April 1st, 2020, the Norman actuarial reports show that the police, fire, and town funds were all at the same liability and asset level. While over the last couple of years, the contributions to OPEB have not been at the same amounts, resulting in a significant shortfall for public safety. And it appears this ties into the need for additional funds and the millage that's being, the 0.6 additional mills being included in the public safety replacement on the August 2nd ballot. The values placed into the account are all recommended by Jason, the chairperson of the board, during budget meetings. These amounts are then approved by the Board of Trustees. So again, it appears to be a manufactured need for funds for public safety. I don't know why you guys made those recommendations. That's something that the board would have to address, I believe. The other issue is on the water and sewer funds. During the budget, Jason here recommends contributions into the OPEB account, and those are approved by the board. Now, when those are approved by the board, that becomes a threshold, a maximum expense that can be made. While the water and sewer contributions are not included or approved by the board, and the funds are moved from the enterprise entity into the OPEB trust. Now, is that a violation of Michigan compiled laws for the treasurer? Is it a violation of the Budget Act? Or is it a violation of the Open Meetings Act? I don't know which one it is. And neither does the prosecutor in Oakland County, because it could be either one of the three. Now, since all the funds are there, the prosecutor also believes that it is.
30 seconds.
Did you interrupt Haley Stevens when she was at 30-second mark? Or is it just me? Or is it a class discrimination? Again, the prosecutor's office said since the funds are all there and accounted for, it's not a criminal act, it's a misdemeanor, but it's still inappropriate. Thank you.
Is there any more public comment? Then we will close public comment and move on to the next item. The draft meeting minutes went out. Is there any changes or a motion to approve those?
Motion to approve.
Motion by Brian, support by Michael. Meeting minutes are approved as submitted. We'll turn it over to Brian from ANCO for a financial investment review of the second quarter 2022.
All right, so a couple things we'll walk through. We'll start from an overall market commentary standpoint. So we're talking about the second quarter of calendar year 22, but I feel the need to preface comments that from a township standpoint, we're talking about the first quarter of the fiscal year. And those conversations have been different. I had a meeting on Monday in Wayne County, and with a 9/30 fiscal year, they're looking and saying, well, we're 9 months in. Prior to that, I had a meeting in Auburn Hills with a December 31st fiscal year end. So it's based on when your year ends is the magnitude of importance of the most recent results. Obviously, a lot of cities in the state of Michigan, from a revenue sharing standpoint, are set up on June 30 fiscal year end, so this is a critical moment for a lot of those communities. But we're 3 months into the fiscal year specific to the township. You know, I think about the reaction to Q1 of the calendar year versus Q2 of the calendar year, and I would say the reaction to Q1 was, wow, that wasn't as bad as I thought it was going to be, and the reaction to Q2 was, wow, that was actually a bit worse than I thought it would be. And you can see that bear out, for example. You know, S&P 500 for the quarter was down 16%. Mid-cap stocks down 16 and change. Small-cap stocks down 17 and change. And international markets, depending on where you were, interestingly enough, actually outperformed U.S. markets. But this is more due to U.S. dollar movement and not due to, oh, you know, the DAX outperformed or, you know, France outperformed. So developed international stocks in U.S. dollar terms were down about 14.5%, and emerging market stocks, again, big U.S. dollar impact here, as we've seen significant strengthening, was only down 11.5%. And that brings us, depending on what you look at on a year-to-date basis, you know, if we rounded this to just, you know, no decimal points to the right of the decimal, you know, the S&P's down 20%, so you're in bear market territory. Remember, down 10, peak to trough, is a correction. Anything down 20 or more is labeled as a bear market. Why we have those definitions, I don't know, but that's just the way it's always been defined from a Wall Street standpoint. And you can see, you know, that down 20 or more figure kind of holds in across the board. Mid-cap stocks down 21.5, small-cap stocks down 23.5, and international markets, again, slight outperformance, but no one's doing victory laps for saying I owned more international than U.S., and I was only down 19.5% in my domestic or my developed portfolio, or only down 17 and change from an emerging market standpoint. So the bigger impact, I would say, this quarter and this year was the thought of traditional diversification that had traditionally saved investors in the past, right? Oh, you just told me the stock markets were in difficult territory, but I've got 60% in stocks and 40% in bonds, so my bonds would have saved me, and they didn't. You know, depending on your measure, broad, high-quality U.S. fixed income, so that would be the U.S. aggregate, was down 470 for the quarter and is down more than 10% on a year-to-date basis. Worst start to the year for high-quality U.S. fixed income since the beginning of time. Like, not in the last 20 years, not in the last 40 years, but it's my understanding that's the worst 6-month period for the fixed income markets ever, for that U.S. Ag index. And if you said, well, you know, I moved out of treasuries on interest rate concerns and, you know, went into corporate investment grade bonds. Well, you weren't down 10 for the year, you were down 14. And if you said, well, I shifted out of investment grade and I actually looked at some high yield options, which given the rally in energy, one would have actually expected to outperform, but they were still down 14% on a year-to-date basis. So there's really, from a traditional investment standpoint, short of cash, nowhere to hide on a year-to-date basis in the last year. And if you thought cash was a good place to hide, your return may have been positive, but if you think about it on a real basis, you know, if your cash portfolio was up 1% in the last year, you're actually down 8 because we just had a 9% inflation a 9% print on the inflationary number from June of 21 to June of 22. So in terms of good news, there isn't much. Other than, so I was at a conference in Newport, Rhode Island last week. I spoke on a panel Monday afternoon, and I was on the panel with a trustee from Savannah, Georgia, Fidelity's head of multi-asset portfolios, and a fixed income portfolio manager. And the topic was, like, equity and fixed income markets, where are they going? And the moderator was actually an advisor based in Connecticut, and he started with, you know, we're in bear market territory for the equity markets. We're flirting with bear market territory for fixed income markets. Consumer confidence is at an all-time low. Small business confidence is at an all-time low. Fortune 500 CEO confidence is at an all-time low. Where do we go from here? And the first guy up was the bond guy. And for him, the world is ending. For the multi-asset guy, it was, look, we're finding opportunities in a variety of different situations. And my first comment was, every time I hear someone rattle off all that, right? Equity markets are in bear market territory, confidence is at all-time lows, investor pessimism is at record highs, right? All of the sentiment is negative. That feels a lot like a bottom, right? When we've heard that in the past, when we're going through periods of equity market performance like this, those are usually signs of a bottom forming. You know, you look at the S&P 500, we've kind of leveled off. July, we've rallied back a bit, but we kind of seem to be stuck in this range of, you know, a low of 3,500 to a high of 4,000. And we've had more moves of plus or minus 2% so far this year than we've had moves of plus or minus somewhere between 0 and 1. So there's been more big swings one way or another. And we'd expect that to probably continue, because if you think about it, you know, the news cycle is either positive or negative. There isn't any directionality to it. So that's going to keep us range bound for a while from a market standpoint. The other really interesting thing that's going on from a consumer standpoint is, when I was sitting in the parking lot, I was reading an article, you know, Walmart missed, Target missed, Dollar Tree beat. So from a lower middle class or lower income class standpoint, like, we're trading down from Walmart and Target to Dollar Tree from a day-to-day purchase standpoint, yet LVMH beat. Oakmark, one of the international equity managers, bought Kering, which is Gucci, Saint Laurent. So you've got, like, look, we're not buying patio furniture anymore, we're now focused on groceries, but then you have a segment of the population that's buying luxury goods in record amounts. So there's a pretty big bifurcation in what the consumer's doing based on where they sit from an income standpoint. So another just interesting piece. So you can think about that, you know, with gas at $5.50 a gallon versus $2.50, it's a significant impact based on where you sit from an income standpoint. So digging into the portfolio, you know, for the quarter, down 10.6, just slightly ahead of the policy index, kind of an empty victory lap to celebrate outperforming when they're still down 10%. Obviously, the quarter is the fiscal year to date. In the last year, down about 15.7 versus the policy index down 13.5. I will tell you the median public fund, so peers around the country, for that 1 year time period is down in the neighborhood of 15 to 16%. So there's a number of systems that have actually fared considerably worse in the last year, and a handful that have done better. So where did that come from? Right, it's negative numbers across the board. Ancora, slight underperformance, really due to holdings in B of A, and two names that are actually were non-index positions but are now index positions, and that's Apple and Microsoft. No surprises at fatality in that S&P 500 index fund. It is interesting to see the concentration there. So there's, believe it or not, there's 507 names in the S&P 500, not 500. But if you look at the top 10 names, so top, like 10 out of 500 is 2%. Those 10 names, while they're 2% of the names, are 28% of the benchmark. They were collectively down an average of 25% in the second quarter. And that basket of stocks was 6.6 of the 16% decline. So 10 names essentially contributed to 41% of the decline of the index. That gives you an idea of the concentration that you see. If you take it to large cap growth and look at Edgewood as an example, so Edgewood underperformed for the quarter again, 22 stock portfolio, always a 22 stock portfolio, really impacted by some names in healthcare and communication services. If you look at that Russell 1000 Growth Index, so there's about 570 stocks in that benchmark. The 5 largest names make up 35% of the index. The last time we saw that level of concentration was in the late 90s. So any decision to move away from not having a 13% position in Apple or Microsoft and having a more diversified portfolio is going to have an immediate impact as those names move higher or lower. Difficult performance as of late. I would note, if you go all the way to the back of the book, one of the pieces that we include is the longer term performance for each of those strategies. They're top decile on a 10-year basis. So near-term underperformance, we've seen them go through periods of outperformance and underperformance like this before. You're going to have it with a 22 stock portfolio, right? There's just It's diversified by names, but because you look so much different than the index, when there's big swings in the market, you're going to see significant outperformance or underperformance. Clarkston, topic of conversation last year because of their underperformance. You don't see it here, number one in their peer group. They were down 7 for the quarter. They're down 9 in the last year. So they were 9% ahead of their benchmark for the quarter and were 12% ahead of their benchmark in the last year. It's funny, it's beer and food. Post Holdings, Cisco, Molson Coors, and a little bit from a financial standpoint with LPL. Are all names that have either been in positive territory or have held up really, really well. Fidelity Extended, again, it's same interesting commentary here. So that benchmark is actually just over 3,600 names. And remember, that is take the entire U.S. equity market, kick out the 507 names that are in the S&P 500, and own the rest. Top 10 names there represent 7% of the index, with an average decline of 36%. And those are a lot of tech names and a bit more concentration. From an international standpoint, Oakmark, which had been struggling, turned in a pretty solid quarter, down 11.7, almost 3% ahead of their benchmark, lagging in the last year. Longer-term returns for them, same stories with Edgewood, top in their peer group. 75 stock portfolio, bit of a value bias to it. They had some interesting commentary. So this portfolio has been around for 30 plus years, and it's a value portfolio. So they're big on buying a solid company, solid business at a discount to what we think the long-term intrinsic value is. So at market peaks, their portfolio is traditionally traded at 75 to 80% of their intrinsic value. Periods of maximum stress, think March of 09, think March of 20, that portfolio is traded as low as 35% of intrinsic value, right? Steep discount. At the end of June, it was trading at 50% of their intrinsic value. And their take on that was, historically this has been a great entry point and been a great start for a period of outperformance. Big drivers for them were names like Prosus, which is kind of it is the Dutch subsidiary of a South African company that you can think of as the Berkshire Hathaway of South Africa. They own a 30% position in Tencent. They announced during the quarter that they were going to start to liquidate their holdings in Tencent and use that cash to buy back shares and essentially close the NAV. So it is a portfolio. It's a stock that's comprised of ownership shares in other publicly traded companies. And because of the perception of Prosus, the stock is trading at a discount to what the underlying. So if they liquidated the company, they would actually generate a profit because the underlying companies they own are trading at a higher value than what Prosus shares are. So that name has rallied based on that move and closing that NAV. As I'd mentioned early on, this is where it's interesting from a consumer standpoint. One of the stocks they added to the portfolio in the quarter was Kering, which is Gucci, Saint Laurent. It's a luxury goods manufacturer that you think we're facing, inflation and global recession, and here's a value manager that sees significant opportunity in a luxury goods manufacturer. Then finally, J.P. Morgan, emerging market only portfolio, slight outperformance for the quarter. Really interestingly driven by a lot of names from a Chinese e-commerce standpoint. Kind of this idea of we're going to shift maybe from a zero COVID policy to a COVID management policy. You might start to see some reopening. So you've seen some rally in names like that. So JD.com, which would be the second largest Chinese e-commerce company, Yum Brands China, and the other big driver for them was the Unilever of India. So think consumer goods, consumer durables. Finally, from a fixed income standpoint, as we've mentioned, no place to hide. Baird only down 2.6. It's hard to get excited about seeing a fixed income portfolio down 2.6, but we were just talking about 15 to 20% declines out of things from an equity market standpoint. Slight underperformance for them, not because of a call on interest rates, but just because they have a bit more exposure to corporate bonds in that portfolio. as we've mentioned, anything other than treasuries underperformed for the quarter as we were completely risk off. And then Brandywine underperformed for the quarter. Again, not necessarily because of a wrong interest rate call, but for them more impacted by currency movements, less US dollar exposure. And as the US dollar strengthened in the quarter versus literally every currency around the globe, that caused a slight drag for them from a performance standpoint. So as I'd mentioned, really no place to hide. Still held in versus policy index, held in versus peers. Some notable underperformance from a couple strategies expected, and some notable outperformance from a few strategies that, again, was expected given market dynamics. That's the extent of prepared comments. Happy to answer any other questions.
Thanks, Brian. Any questions from the members?
Yeah, what was the answer? Where do we go from here?
I think we're sideways for a while. Look, I think from a downside standpoint, we get it. This afternoon will be interesting. We're probably going to see a 75 basis point hike. Could be 100. I'm going to dig a bit more. It's funny, article says we're going to be at 3.5% Fed funds by next summer, and then read another article that says we're going to be at 1.5 by next summer. Had a colleague had a conversation with actually one of the Edgewood PMs, and their belief in the next 2 years is we're kind of back to this slow growth, low interest rate environment that would be pretty favorable for high quality, both on the value and growth side, but just slow growing, high quality companies with kind of inflation proof businesses. But in terms of directionality, I think we could be down another 10% from here just based on negative news. But as I'd mentioned on the front end, when every headline is negative sentiment, pessimism, low confidence, from a historical standpoint, those are signs of us being maybe not at a market bottom. I'm not going page one above the fold, making the call that we're going to rally from this point forward. But it's certainly signs that we're a heck of a lot closer to the bottom than we are to further carnage.
Anything else? No. Thanks, Brian. Next agenda item, following the same schedule as we have been, the next quarterly meeting would be October 26th at 7:30 a.m. Any new business? Hear none. Then we will adjourn 7:52. Thank you.